Every year around the same time, you might receive a call or an email from your financial advisor. They suggest that now is the time to transfer your 401k into their investment company. They frame it as an upgrade, a chance to access better tools, or a more personalized strategy. It feels like a routine administrative task, a necessary step to keep your retirement plan on track. But here is the thing. This annual request is rarely about improving your financial future. It is about the incentive structure that drives the advisor to ask for the transfer in the first place. To understand why this happens, you need to look at how financial advisors get paid. Most advisors work on a model based on assets under management. This means they charge a percentage of your total portfolio every year. When you keep your money in your employer-sponsored plan, the advisor often cannot charge these fees directly. The plan rules restrict them. But if you roll that money over into a personal individual retirement account that they manage, they can charge their fee. That is the primary motivation. The annual request is a mechanism to generate revenue, not necessarily to generate better returns for you. Think of it like a subscription service. You are already paying for a service through your employer plan. The advisor wants to move you to a service where they can charge you a direct fee. When you move your money, you are not necessarily getting a better product. You are often paying more for access to the same or similar investment options. The expense ratios on the funds available in a standard 401k plan are often lower than what an advisor can offer on their proprietary platform. By moving your money, you might be increasing your annual costs without any corresponding increase in performance. There is another risk that is frequently overlooked during these conversations. 401k plans offer a specific legal protection called creditor protection. If you are sued or face bankruptcy, the money in your employer-sponsored plan is generally shielded from creditors. When you roll that money over into a standard individual retirement account, that federal protection can disappear. You become subject to state laws which vary significantly. You might be moving your retirement savings from a fortress into a house with an unlocked door. An advisor who prioritizes fee collection over your legal safety is not acting in your best interest. Consider the psychological aspect of these annual requests. This is a tactic known as the status quo bias. By asking you to do something every year, the advisor creates a pattern. You begin to view the transfer as normal. You stop questioning the cost or the risk because it has become a habit. You stop shopping around for better alternatives because the request feels like a standard procedure. This repetition is designed to wear down your resistance. It makes you feel like you are missing out if you do not comply, when in reality, you are likely just paying for convenience. There is also the element of churn. This term refers to the practice of moving assets around to generate transaction fees or to reset the clock on performance fees. When an advisor asks you to transfer your account annually, they are effectively resetting the relationship. They are ensuring that their fees continue to accrue without interruption. They are preventing you from accessing the lower-cost, diversified investment options that might be available outside their specific platform. This is a retention tactic. It keeps your money in their ecosystem where they maintain control and visibility. The rise of artificial intelligence and robo-advisors has changed the landscape of financial advice. These digital tools can optimize investment decisions through machine learning without the human conflict of interest. They can analyze your portfolio and suggest changes based on data, not on the need to generate a commission. This technology highlights a future where clients can independently verify advisor recommendations. If an advisor cannot provide a transparent cost-benefit analysis for a rollover, the algorithm will tell you that the move is unnecessary. This independent verification is a powerful tool to counter the pressure of annual solicitation. You should treat every annual request as a new proposal, not a routine maintenance task. Ask for the specific expense ratios of the funds they are recommending. Compare them to the funds you already hold in your employer plan. Ask about the loss of creditor protection. Ask why this transfer is necessary right now. If the answer is vague or focuses on the advisor's convenience, you have your answer. You do not need to accept the request every year. You can choose to stay in your current plan if it serves you better. The goal of retirement planning is to accumulate wealth and protect it until you need it. Every fee you pay is a drag on that accumulation. Every risk you take without understanding it is a threat to your security. When an advisor asks you to move your money, they are asking you to trust them with your financial security. That trust should be earned through transparency and performance, not through annual repetition. You have the right to say no. You have the right to keep your money where it is protected and where the costs are lowest. This is about taking control of your financial narrative. The annual rollover request is a signal of a conflict of interest where the advisor prioritizes asset accumulation for fee generation over your optimal investment strategy. By recognizing this pattern, you can protect your assets from unnecessary erosion. You can ensure that your retirement savings are working for you, not for them. If you find yourself in this situation, do not let the annual pressure dictate your decisions. Audit your account. Compare the fees. Understand the risks. Make the choice that aligns with your long-term security rather than your advisor's short-term revenue goals. This is the difference between being a client and being a target. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.